Good afternoon to all of you. The basic of the ratio analysis, about the ratios we have discussed in my first lecture, that is denoted by A. Now this is B. In B, we will discuss the profitability first, because profitability. Because we want to know the profitability of a project, of the profitability of a business organization. So, what are the different ratios which we take it into considerations to know the profitability of the business? And how we calculate, how we analyze the profitability of the business? With the help of which statement? That is income statement, that is called PL, profit and loss account. So, profitability ratio you will discuss with the help of profit and loss account. Profit and loss account doesn't mean only PL account. Profit and loss account means the combined manufacturing, trading and PL account. And you know well, in manufacturing account, you calculate cost of production. And PL account, trading account, we calculate gross profit. And in PL account, you calculate net profit or net loss. So we keep it into consideration. So all these combined manufacturing trading account, which is known as PL account also, here we are considering. So first of all, we want to calculate net profit ratio. Net profit ratio. So why we want to know the profitability of the business? Very easy. Because we want to know the proportions of the profit with respect to sales. Because in profitability, all the profit, whatever the ratios you want to calculate, each and every ratio has relation with sales. Simple. So, if anyone will ask you that profitability has a relationship with sales. So if anyone will ask you that my profitability is 10%, 10% means what? 10% of sales. So profitability has a relationship with sales. So very easy. Net profit, if I ask you how you calculate and why we calculate net profit ratio, here we want to calculate net profit ratio to know the net profit, proportions of net profit in sales. So, proportions of net profit with respect to sales. So, very easy to calculate. How to calculate? Net profit with respect to net sales. And because profitability we want to calculate, so profitability always expressed in percentage. So in all profitability ratios, we have to multiply it by 100. So expressed in percentage form. So will be multiplied by 100. So this will be multiplied by 100. So suppose net profit is 10,000, net sales is 1 lakh. So how much percent? If we will not multiply it by 100, very difficult to calculate, very difficult to say how much percent. This is 0.10 in decimal form, but we never say anyone as net profit ratio is 0.10. So we have to convert this decimal form in percentage form, and so it multiplied by 100. So when you multiply by 100, 30 30 cancel, 20 cancel. This is how much? This is 10%. So net profit ratio is how much? Net profit ratio is equal to 10%. Now you see, 10,000, 10% of 1 lakh is how much? 10% of 1 lakh is 10%. 10% of 20% of 1 lakh is 20%, 20,000. So 30% of 1 lakh is 30,000. 40% of 1 lakh is 40%. 90% of 1 lakh, 90,000. So 100% of 1 lakh, 1 lakh. So 10% of 1 lakh is 10,000. So this 10,000 is how much? 10% of 1 lakh. So in this way, we have seen the net profit ratio is 10%. And if we compare the profitability of so many alternative projects, so higher the net profit ratio, better the project. And in that project, we will invest our capital. Is that clear? So now, in this way, if I say second ratio, that is called gross profit ratio. Gross profit ratio. Gross profit ratio. Again, very easy. Gross profit divided by what? I already told you. All the profitability has a relationship with sales. So net profit divided by sales. Gross profit divided by sales. Cost of goods sold divided by sales. Administrative expenses divided by sales. Selling expenses divided by sales. Whatever the ratios related to profitability, PL account, everywhere you divide it by sales and multiply by 100. Simple. So gross profit divided by net sales multiplied by 100. If suppose gross profit is 20,000, suppose divided by 1 lakh multiplied by 100, 30, 20 cancel. This is how much? 20%. So gross profit ratio is how much? Gross profit ratio is 20%. 20% of what? 1 lakh. As you know, 10% of 1 lakh is 10,000, 20% is 20,000. Is it? Very easy. Gross profit ratio is equal to 20%. Any doubts to anyone? Yes.
How to calculate gross profit, sir?
Gross profit you calculate with the help of sales minus cost of goods sold. I will discuss you. You go step by step. Okay? You go through step by step.
What is the difference between EBIT and gross profit?
Here you don't EBIT. At this moment, I'm just discussing you the simple questions. EBIT is earning before interest and tax.
What is the difference between gross profit?
Okay? This EBIT is earning before interest and tax. And earning before interest and tax, when you calculate PL account, I will discuss you just right now. What is the difference between gross profit and EBIT? Just wait. Don't jump. If you will jump, you will fall down. And then I will not save. So please go step by step. So any problem regarding this profitability, that is net profit and gross profit ratio? You, any problem? Okay, good. Very good. Now, I will discuss you. Third one, that is cost of goods sold ratio. Very easy. This is cost of goods sold. This is cost of goods sold divided by net sales multiplied by 100. Suppose cost of goods sold is 50,000. Suppose this is rupees 1 lakh. This is multiplied by 100. 3030. This is how much? 50%. Cost of goods sold is 50% of sales. As you know, 10% of 1 lakh is 10,000, 20%, 20,000, 40%, 40,000, 50%, 50,000. Easy, very easy. So cost of goods sold ratio is 50%. Now I would like to discuss. I'm just want to discuss very important ratio. The rest one is very simple, which you can go through the book and you can easily understand. Now the next one is ROI, return on investment. Return on investment. Okay, so return on investment, how you can calculate return on investment? This is yes, anyone can say how you can calculate return on investment? Yes, anyone?
Return divided by investment.
Net profit divided by capital employed. Is that clear? And this is what this net profit is. I will discuss you EBITD.
EBIT is the net profit.
Okay. So this is your return on investment. Now, how we can calculate this return on investment? Here is return on investment, and or you can say here there are so many definitions here. Return on investment, return on capital employed. Return on investment, that is total assets. Again, we will calculate return on capital employed. Where you are investing your capital? Okay, you are investing your capital in assets. Now, if anyone will ask you how you calculate return on capital employed, this is also net profit divided by capital employed. Both are same, but the nomenclature is different. Okay, so now here I don't want to write here EBIT because I will discuss you later on this EBIT multiplied by 100. Here also multiplied by 100. Now again I will discuss. This is E. Now F. How you calculate return on shareholders' wealth. Shareholders' wealth. This is called net profit. Net profit after interest and tax divided by shareholders' wealth. Okay. Now, next one, G. How we calculate return on equity shareholders fund? Return on equity shareholders fund. See, there are different types of net profit. One is net profit before interest, tax and dividend. One is net profit after interest, tax and dividend. So all are the steps when we calculate P&L account. So return on equity shareholders, that is the last remaining profit which will be distributed among the equity shareholders. Is that clear? Because after that there is no one to get the profit. So first of all, from operating, or you can say earning before interest, tax and dividend if I say, from that earning before interest, tax and dividend, first of all you are liable to pay the interest. To whom? From whom you borrowed fund. After that, that's the reason why government is asking you to take home loans. Why? Because the total interest will be deducted from your salary, and thereafter you will liable to pay tax. So after paying interest, you have to pay tax to the government. And that profit will be distributed among the shareholders. Now you have already paid the the return to the debt capital holder, that is interest. Thereafter you have paid tax to the government. Now the remaining profit is the profit on which only there are two people who deserves. That is, number one is preference shareholders and thereafter equity shareholders. So after paying tax, the first person liable to get the return, that is dividend to the preference shareholders. And after paying to the dividend to the equity preference shareholders, the last part is equity shareholders. So there are so many returns you have to calculate. And this is the last return on equity shareholders. And return to equity shareholders fund is what? Now it is easy for you to understand. That is net profit after interest, tax and dividend. To whom this dividend? To the preference shareholders. Why? Because we are going to calculate the return proportions, that is remaining proportions of the profit, which we are going to distribute among the equity shareholders. Is that clear? So net profit after interest, tax and the dividend. And this dividend doesn't mean the dividend you are distributing to the preference shareholder, equity shareholder. No. This dividend which I am writing here, this dividend is specifically for the preference shareholders, divided by equity shareholders fund. Is that clear? So this is your EAITD. And what is this? This is your EBITD, earning before interest, tax and dividend. Here you neither paid interest, nor paid tax, nor paid dividend to the equity shareholders as well as preference shareholders. Why? Because I want to calculate the return with respect to the total investment, how much I have invested. So that investment you have paid, that I have already discussed in capital budgeting. That is long-term investment for what? Fixed assets. So long-term investment from whom you got? By debt capital as well as from owner's capital. So here the total earnings are there, and that you have to correlate with the total assets. Total assets means total investment. So EBITD, here is EAITD. This is the difference between the two. Clear? Already doubts you have? You don't have doubts. Yes?
How to calculate some capital employed?
Capital employed you calculate with the help of, with two different ways. Okay. Should I clean this board? Thereafter I will calculate capital employed. Okay? Good work. Now I think I have discussed the whole profitability, right from net profit, gross profit, cost of goods sold, and then after the simple ratio, that is operating expense ratio, operating expense divided by net sales, administrative expense divided by net sales, financial expenses divided by net sales. So all other ratios are very simple to calculate. So now, better I will prepare PL account. In this PL account, we will discuss the steps by steps. First of all, I want to discuss manufacturing account. Maybe you never studied manufacturing account separately because you are from BCom, maybe. And if you from BBA, then maybe the teachers taught you manufacturing account. Otherwise, straightway trading account. And you forget how you calculate cost of production. You directly have calculated gross profit. That I know. So, but I want to discuss separately manufacturing, because in business there are two types of people. One is involved in converting the raw materials into finished goods, and the other one is just buying and selling goods without alteration, without adding something on the raw materials or finished goods. So there are two types of persons. One is in trading business and one is in manufacturing business. So manufacturing business, the person who is involved in manufacturing, what they calculate? They calculate that how much cost incurred in converting the rice into bhat. That is raw materials to finished goods. That is cost of production. So how you calculate? Simple. I will give you the example of manufacturing account by taking into consideration very simple example very near to your surroundings. What is that? You go to kitchen, because I have already discussed this manufacturing all over the world, keeping into consideration this example. Now you go to the kitchen first. You entered in the kitchen, yes? Otherwise you will not understand this manufacturing. Now come. In manufacturing account, this one is CR side, this one is DR side. DR side means debit side, expenses side, and CR side means income side. In manufacturing account, when you enter in the kitchen in the morning, what you find? Suppose you want to prepare some food for yourself. So what you do? What you search first? You search in the buckets whether there is rice or not. Is that clear? Rice or not? It means that the rice which remains in the bucket. What is that? That is the closing stock of the previous days or previous month or previous year. The closing stock of the previous day becomes the opening stock of the current day. It means what? First of all, you have to have the idea about the rice remains in the bucket in your kitchen, which is the opening stock of the raw material. Is that clear? So raw materials, suppose you have 250 grams of rice in your bucket, but you take every day 1 kg of rice in breakfast. Then what you do? You have only 250 grams rice in your bucket, and you eat 1 kg rice in one go in breakfast as well as 1 kg in dinner, lunch. It means you have to purchase. Very easy. So first of all, you take into consideration in debit side you have to write 2. After that, opening stock. Opening stock of what? Opening stock of raw materials. Suppose opening stock of raw materials is 50,000. Now, opening stock, that is half kg or 1 kg of rice, 50,000. But you take 2 kg of rice at one go. It means 1 kg of rice you have to purchase. So very easy to purchase. Purchases of raw materials, rice. Suppose 70,000. Now you have, it doesn't mean that if you eat only 2 kg rice, you will purchase only 2 kg, maybe 3 kg, maybe 4 kg, whatever. 70,000 of rice you purchased. Now what happened? That rice will not come at your place by flying in the sky. Then how it will come? Have you seen the truck Yes. Have you seen something written in the truck, in the front of the mirror? Yes. What is that? Goods carriage. Means the goods which will carry. Where? Towards your business or outside the business? Towards the business. Then what you write? And in that truck, this rice you have uploaded and which comes to your place from suppliers. And that is called carriage, because goods carriage you have seen in the truck. So carriage in word which will come. And in your factory there are two gates. One is in, one is out. From which gate it will come? From in or out? In. So carriage in word. So very easy. Two, carriage in word. Now the truck is standing outside the factory, inside the factory, but rice is uploaded on the truck. What do you think? That the sack bag of the rice will come by flying in the sky in your factory? No. With the help of labor, worker. So what you pay to the worker? Wages. Okay? Wages. So, two wages. Now, the supplier sent the rice on truck, carriage inward. You have unloaded the rice from the truck to your factory with the help of labor, to whom you paid wages. Clear? Now, rice is in your factory. That is, factory is your kitchen. Now what happens? Now you take some of the rice in your bucket, put water, and that bucket you put it on the stove. Have you seen something burning, blue, 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 blue? What is that? That is gas. Okay? That is gas. And that is your expenses. That is your expenses. Raw materials, wages, and expense. There are only three expenses in the business. Raw materials, labor, and expenses. And this is not wages. The burning, gas is burning to cook, to convert that raw rice into cooked rice. And that is blue flames which comes from the gas. And that is what? That is your expense. And that is what you write? That you write either if you use petrol or some gas, cooking gas, that is called power and fuel. Power and fuel. Suppose you are welding or soldering some, because you are involved in furniture manufacturing, in which leg is built with the help of iron and the top is with the help of wood. How you bend the iron? By heating. And after heating, if you touch that, what happened? Your hand become very good. There is a burning. So before you touch hand, you have to cool it. So that is called heating and cooling. So to heating and cooling. So you have paid the cost of the raw materials. You have paid to the labor wages. You have paid the expenses of heating and cooling and power and fuel. Now your rice being cooked. And cooked rice, where you keep the cooked rice? In the kitchen? No and never. Where? In the showroom. Where is the showroom? Dining table. Dining table is your showroom. Where my mother will cook the rice and keep it in casserole. And what I will do? I will come and eat. What the showroom of some Maruti or Tata or whatever, they manufacture the car and kept in a showroom, and the people like us will go and buy. Dining table is also like a showroom, where I will come and eat, I will consume, and I will put the money on the dining table. Clear? So, what happened? Now come to this is our expenses. Now on the income side, you write buy. Here is your opening stock of raw materials. Here is closing stock of raw materials. Why? Because some of the rice remains in the bucket. Because you consume 2 kilo of rice, but you purchase 3 kilo of rice. So 1 kg of rice remains in the bucket, which will become the closing stock of today, and which will become the opening stock of tomorrow. So this is by closing stock of raw materials. Suppose 10,000. Clear? So remaining rice you kept on the trade side, that is income side. The expenses side you have written right from raw materials you purchased, after that heating and cooling and power and fuel. Rest all the expenses being general important heads which I have written here. That this steps may vary from business to business, from one business to another business. That when you go through the book, you can easily understand now. Because I have taken the simple example which you can understand easily. Now you convert that kitchen into Maruti, kitchen into some business like Nurani Tel. You are producing Nurani Tel or whatever. That depends on. Now, suppose this side is, suppose carriage out what 10,000, suppose wages 20,000, suppose power and fuel 5,000, suppose heating and cooling 3,000. Now if I will add this, $158,000, that is 1,58,000 rupees on the expenses side. Now debit and credit must be equal. That is 1,58,000. But if you are the foreigner student, then 1,58,000. In place of 1,58,000, you say 158,000, either in dollars or in real or in bill or in whatever the currency you can. So, out of 158,000, 10,000 of the raw materials remains at your disposal. So the balancing, you have to balance both debit and credit side. And the balancing figure of manufacturing count is what? That is cost of production. That is the cost incurred in converting the raw materials into finished goods. So this is 1,48,000 rupees. And this is what? This is your balancing figure, and this is your cost of production. This cost of production after manufacturing, where you send it, you send your cooked rice on the dining table of your house. And what is this dining table? This dining table is a showroom where the people will come and buy. So I'm treating this dining table as a showroom. So now you prepare trading account. And this cost of production transferred to trading account. Now this will be transferred on the opposite side, because this is the balancing figure. This is the expenses. Because your expenses is heavier, income is less. So this balancing figure is your expenses side. So the expenses side, the real expenses side of the business is what? This side, DR side. So this will go to cost of production. Here I have written transferred to trading account. Here I will write transferred from where? Manufacturing. Manufacturing. How much? 1,48,000. Is that clear? This amount balancing figure will transfer from here to the debit side of the trading account. Now, in trading count, what you will consider? Finished goods, cooked rice. Here I have written raw, uncooked rice. Here is the dining table where you are trading.